Hi, I'm Margaret, Director of the Carbon Program here at Trellis Group. And today I'm with Dr. Carla Woydt, Chief Impact Officer at CEEZER, and we're talking about managing risk in carbon credit purchases. Hi, Carla. Thanks for joining.
Hi, Margaret. Thanks for having me.
Purchasing carbon credits can be such a good way for a company to mitigate the emissions it hasn't managed to avoid or reduce from its supply chain yet, but it can be a challenging decision-making process. So I want to talk to you about you work with clients all day long who are navigating this process. What are the three biggest risks that you see them encounter as they make their carbon credit purchases?
Exactly. I mean, if done right, carbon credit purchases can be a very good tool to complement your reduction activities. The three biggest risks, however, is one, the quality risk. So are the credits you're buying at the right quality? Do they really have a climate impact? The second risk is what's the host country? What's the geopolitical risk? Is the activity included in the national NDC? So any risk that is related to the host country. And then there is a whole risk, and this is very often overlooked, around the transaction itself. So what is happening to the price? Is it the best price you can get? Is there enough transparency about the price? How a price is going to develop over time? Is there enough supply now? Will there be in the future, looking at longer term commitments of a corporate? And then also, what about demand? So what are the demand patterns? Who do I have to compete with? And can I really make sure that I invest in a project over a longer period of time? And this is true for a project on credit level, but this also holds true for certain project types where we already see that demand is picking up whilst volumes are not catching up with the demand, and where it might be difficult at a later point in time to get the right supply.
All right. So of these, it's a pretty significant list and a lot of different types of risk that a buyer has to manage. So of these, which do you think is the most important to pay attention to, and how do you advise your clients to manage that risk?
Well, that's a very good question, because I wouldn't say there is this one risk that is most important. I think the market is really focusing, or used to focus, very, very much on the quality risk, just because it's very complex, and every single project, not only are there so many different technologies, but also every single project within the same technologies has different exposure to certain risks. One might be a more or less additional, or there might be a higher or lower risk of leakage. But all of that is really only valid to look at if you know that you can get that for your budget and over time, right? So you can have the best project, but if you will not be able to purchase this next year or the year after to really complement your reduction activities, you might not care about its integrity because it's still not available anymore. So there is not really one risk, but I'd say the beauty is really to embrace the whole breadth of risks that exist, and then to go really deep down on detail level for every single credit that you're purchasing, based on concrete data points, and inform your purchasing decision on the different dimensions, integrating all the different risks.
All right. So now I want you to pull out your crystal ball for a second. I'm curious if you think the risks that buyers will be facing, say, 5 years from now, are different from the ones that are top of mind today.
I think they will. A couple of risks will stay the same. However, new technology, let's look at MRV, for instance. I think the whole integrity question might, for some project types, become a little more easy with new technologies being introduced, different ways to monitor and verify, and also different standards and different standard setters coming into play. However, looking at demand projections and supply projections for certain project types, there will be a shortage. And this is expected to be around or in about 5 years, right? So I think the market will turn, and then buyers will be definitely faced with the fact that there might not be enough supply to meet their net zero target. And this is what they already have to take into consideration today, right? So they have to really inform their long-term purchasing strategy on data, but also on projections of how the market is going to develop, to make sure that they have the right supply at the time they will really need it, which means at their net zero target year.
Okay, so what are some of the most important tools that you think buyers can use to mitigate these risks?
First is to draft a long-term strategy, a purchasing strategy over multiple years, informed by clear data. We work with over 30 million data points to build the most powerful portfolios, and I think this is also what buyers should take into consideration: having clear data points that are material to their strategy and that they use to really inform and define their strategy over the next 5 to 10 years. And then based on this, you can also select of different mitigation strategies. If you, for instance, know that certain project types will not be as available in the future, so there will be a supply shortage that is predicted, you might want to engage in long-term offtake agreements right now. That helps you to secure the best prices, but also to make sure you have the supply when you need it, which is for most of the companies at their net zero year. So you have the supply to scale, you have to secure the credits you need, and you have to lock in prices. On the other hand, for certain project types, there might be some risks in the future with respect to their, let's say, additionality. So there is a quality risk. For those credit types, you might not want to engage in a long-term offtake agreement, but rather purchase on a spot basis year after year. So your strategy for this category might be more informed by quality risks and short-term risks that you want to look at. So you really have to make sure that not only your purchasing strategy is informed by data, but also that your mitigation activities will kind of react or address the risks that you identified in your strategy.
All right, sounds like a lot of opportunity for carbon buyers to use carbon markets to have real climate impact. So, Carla, thank you so much for joining me in the Trellis studio.
Thank you very much, Margaret.